My name is Hamilton Lin, President and Founder of Wall Street Training, and I have a background in investment banking and mergers and acquisitions, having worked at Goldman Sachs' Investment Banking Research, Bank of America Securities' Mergers and Acquisitions Group, and several other boutique investment banks, all focused on mergers and acquisitions. Please note that these materials are copyrighted and may not be disseminated or reproduced without express written approval from Wall Street Training. Wall Street Training is a corporate training firm focused on teaching the concepts of financial modeling and valuation. We also hold a fair amount of public open enrollment seminars as well as self-study video-based learning. The range of our topics range from the basic and fundamental courses of accounting, how to analyze a 10K, to corporate valuation, as well as the basic financial modeling concepts, including the advanced financial modeling and valuation, as well as complex merger and acquisitions, as well as complex leverage buyouts. Again, my name is Hamilton Lin, and I will be your host throughout the duration of this particular session. You can read more of my bio on your own. Some of the valuation questions that we will try to address today are the following discussion topics. We will review a brief overview of the major valuation methodologies in valuing a company. We will focus on the concept of enterprise value versus equity value, a very important distinguishing factor here. And in fact, if I were you, I would just put a star next to enterprise versus equity value, an extremely important component. We will also briefly discuss the capital structure and the concept of leverage, as well as your basic corporate finance fundamentals. We'll go over a brief discussion of the valuation multiples and implied valuation. Some of the questions we will ask is, how much is a company truly worth? Is it just its current stock price or is it not? How do you tell if a company is undervalued or overvalued? And of course, what is the appropriate premium to buy all of a company's stock? Some of the first questions you might want to ask yourself is, how would you define value? How would you define the value of a stock as well as a company? Towards the end of this session, we will look at an actual case study of Ultramarsh Diamond Shamrock, a refining company, being acquired by Valero Energy Corporation back in 2001. This was a transaction in which Bank of America Securities acted as a sole exclusive financial advisor to UDS in this particular deal. For more information on this, as well as the full transcript of the fairness opinion presentation, as well as the analysis behind this, you may feel free to direct yourself to the SEC EDGAR site, search for Ultramarsh Diamond Shamrock, and download the definitive M14A proxy filing dated August 24, 2001 for the full context and for the full text of this particular deal. However, before we go and enter into our full discussion on this particular transaction and how UDS was valued, let us first go through and make sure we have the fundamental core knowledge of the basics. Folks, valuation is a highly subjective process, and this requires a significant amount of judgment. This is where some shameless self-advertising for investment bankers comes into play. In theory, bankers have the ability to sell the story and properly negotiate the deal. Therefore, from that aspect, you always want to make sure that you have the well-qualified professionals advising you. In general, we always want to use a reasonable and defensible reality check. The reasonable and defensible reality check is extremely important because you need to make sure that if you're presenting in front of the board of directors of a Fortune 100 or Fortune 500 company, pretty clearly the CEO, CFO, and the board of directors are going to know about their company better than you will know about their company. So therefore, you want to make sure that your assumptions, your inputs, and your outputs are all reasonable and that you can actually defend them. In general, also, by the way, valuation is always a range of values and never a specific dollar amount. People will have different ideas on value depending on the public status of the seller and buyer, how it was negotiated, was it a beauty contest, and of course, industry dynamics. Ultimately, at the end of the day, folks, always keep this in mind. There is no one right answer. There is no one right value. The question always is, what are you willing to pay? Now, let's turn ourselves to the basic valuation methodologies. On the one hand, we have basic trading comps. Trading comps are analysis of selected publicly traded companies. What this means is you take a look at the current publicly traded competitors and you see what the value of the market is, what the value the market is placing on these companies are at that particular moment. Then you take those multiples that are implied from the current observations that you make of the open market. Then you go ahead and apply the same valuation multiples and metrics upon the company you are trying to analyze. We will see actual live examples of this. Also, there are deal comps. These deal comps are a similar process as the trading comps, except instead of using publicly traded firms as your competitor, what we're going to use is, let's take a look at previously announced acquisitions in your sector. In addition, we'll look at a discounted cash flow analysis. In the discounted cash flow analysis, what that does is we will see how much we believe the intrinsic value of our firm is going to be, the intrinsic value. You can also say that the trading comps and deal comps, both of these are on top, is what we will call relative valuation. It's called relative valuation because we are looking at our competitors and seeing on a relative basis how much should we be worth. Both the discounted cash flow and LBO analysis are what we will call fundamental analysis. In this fundamental analysis, as well as a breakup analysis, what we're trying to figure out is fundamentally what do we believe the value of the firm will be. Leveraged buyout analysis is also somewhat similar. Leveraged buyout analysis takes a look at the core profitability and the core ability of a company to generate cash flow and then say, let's take those cash flows, leverage this company up a great deal, and use the internally generated cash flows to pay down the debt, hence building our equity. We will have a brief discussion on LBOs towards the end of this particular module. For more information on leveraged buyouts, as well as a fuller explanation of the things you must consider when building a leveraged buyout model, please refer to our module titled LBO Overview. In addition, we also have a breakup analysis. In this breakup analysis, what we will do is we will take a look at a conglomerate, for instance, and we will break up each one of their business units into disparate pieces of businesses. For instance, if you were to try to value a firm like GE, how would you do that? There is no one good competitor that actually builds engines for planes, as well as consumers for credit cards, as well as light bulbs and washing machines, etc. So from that perspective, it would be very difficult, if not near impossible, to pinpoint a very good competitor to use for comparisons against GE. So in that particular case, what you might do is you might separate and break apart each one of GE's disparate businesses, value each one of their businesses based on the previous methodologies, and then sum them up. Therefore, this breakup analysis is also called sum of the parts valuation. Finally, you would also look at asset valuation. If you have a company who has specific hard tangible assets, for instance, refineries, car manufacturing plants, etc., warehouses, you might be able to take this and say, okay, if there's an actively market traded for these particular types of tangible assets that you can split apart from the business, then let's go and see if we were to build all of that up from scratch, how much would this firm be worth? There's another comment, another bullet that I want you to add at the end of this bullet, 4 words. I want you to write in the words as a big bullet: distressed, restructuring, turnaround, or liquidation. Each one of these 4 are very similar to each other, but they are not on this slide for a specific reason. Because what we are trying to value is the value of the company as a going concern. Steady run rate, they will be around, they are not in any financial trouble, they're not distressed, they're not in a restructuring situation, they're not in a turnaround mode, and they're not in a liquidation method or bankruptcy. So
and with that being said, hopefully everybody is following Mr. Hamilton. Trade comps, deal comps, DSF model, leverage buyouts, breakup analysis, asset valuation. Hopefully this information is going to be helpful. Today's class is going to be dealing with contractual indemnification, contractual indemnities. Most of the information will be made available to everyone, regardless of the level that you're on. But I will warn that a lot of the information is meant for implementation. In other words, I don't know how many of you guys as notaries have been reviewing all of the previous video recordings that you've had dealing with exclusive notary training, such as arbitration. It may be to your advantage to do so, because there are some things that you should already know. I don't cover certain things sometimes because I'm under the impression that everybody already knows this. I don't get any questions on certain things, so I kind of assume everybody knows it. I'm going to talk intently about contractual indemnification, and because we're talking about contracts, can somebody in the chat give me an example of a synonym for contract? Like, what is a word that we use a lot in these trainings that is synonymous with contract? Can you if you can you please post that inside the chat, if you didn't mind? Because I want to kind of see where everybody's head is at when we talk about contracts, so you don't get off track. Give me a word that we use a lot in these trainings that is synonymous with contract. And I'm going to give everybody a chance to post their answers. I'm actually scrolling through another doc while you're doing that. I'm looking for something. And because I'm looking for something, this will be easier for me. All right, I'm looking for something, so let's see if I can find what I'm looking for. Let's see. Yeah, contractual indemnities. That's what I'm looking for. All right. Anyone can give me a word that's synonymous with contract. It's synonymous with contract. And if you can, please post that in the chat. Let's go to the chat and see what I got here. I think I got some answers here. Let's see what we got. Okay. We have someone, bingo, ding, ding, ding. Miss Fleming, she answered with the word trust, which will be correct. I always want you to understand that this training is designed to teach you word association. 99% of what's going on is that when people are confused, they don't understand the words that are being used. There's over 7,000 words you're going to use and you're going to learn that's going to allow you to enter directly into the private sector and operate efficiently. And that word contract and that word trust being synonymous is one of those mechanisms. So when they talk about asset valuation and when they talk about contract valuation, and another word for contract is trust, you can associate the methodology of asset valuation, contract valuation in the same vein as trust valuation. So competent fiduciaries are actually able to utilize certain principles or at least be knowledgeable of SEC rules and regulations when it comes to contract valuation to determine true value, or what we'll call in the industry taxable expenses. The growing concern or going concern is a accounting methodology. Something that we will discuss, throughout the weeks to come, because there's something very interesting that happened. How many of you guys were actually in the training yesterday and you heard the gentleman break down the recent cases that the IRS was going over? One particular case in particular that he discussed at the beginning of his breakdown. Did you guys catch any of that? Because if you didn't, this was a very interesting set of events. They talked about what they call in the industry the CRT. Who knows what CRT stands for? It's a type of trust. Who knows what the acronym CRT stands for? Anybody? CRT, and it's a certain type of trust. T stands for trust. So what does the CR stand for? It's a certain type of trust that they're talking about. Post your answer inside the chat if you have any idea what CRT stands for. T standing for trust. Do we got any takers? Okay, so if we don't have any takers, then let me help you out. Charitable Remainder Trust. Charitable Remainder Trust. There was a very influential case that was ruled upon by the IRS dealing with charitable remainder trust. Now, some of you guys might have missed it, didn't catch it, was unaware of what was being talked about and laid out. What I'm going to attempt to do for those of you that might have missed it is to actually, if you will, give me a second to revisit this proponent, because it's something interesting that I want you to pay attention to. See, trust implementation and trust administration To administer over the trust, you're actually to administer over the trust, you're in the role of trust implementation. And some rules don't engage until they move into implementation. You haven't heard me talk a lot about living trust. I've always talked about the trust from this perspective. Why? Because I want to get you the fundamental aspect of trust. But now we come to the second quarter of this year. We're moving into the third quarter. Now I need to progress you down the line of how you need to be looked at, all things being trust. So I want you to really lock into this polarity. And what I'm going to try to do here is find there's a particular, just bear with me because I'm going to have to just manually do this. Let's see if I can manually do this. All right, let me go here because I want to find this particular intel, because if you missed it in the class yesterday, I need you to be aware of exactly how it's being applied, because the Internal Revenue Service has plans dealing with trust, just like they're going to force certain people in a certain trust to take on a certain type of account and a methodology of accounting. This also works in a different capacity, but I want you to hear it from the horse's mouth, so to speak, on what that entails. So just hold on for a second while I cue this up, and because you need to hear it. I don't know how many of you guys were in the training last night. You might have missed it. So I'm going to take the liberty of saying for the first time since you missed it, let's hear it from the horse's mouth so you don't get lost with this. Okay, so it's already there. So now I just need to go to my layout here because they're saying it's already here. So I need to go here, back into there. Let's find it. And bear with me while I retrieve the file. Let's see, we're going to retrieve the file. It should be in here. It's going to be on this right here. Here we go. So we let this load up for a second. Also, those of you that haven't been reviewing your UCC workbook, it'll be to your best advantage to start getting yourself familiar with UCC's dealing with Article 9. Because the Article 9s are going to be some things that you really need to really look at. The Uniform Commercial Code UCC workbook that deals with Article 9s are going to kind of give you, what do I do next? Like a lot of guys have awards that have already been issued to them through arbitration, but they're still a little wobbly on exactly what they should be doing. When you go to Uniform Commercial Code Article 9, this will help you in the aspect of implementation and enforcement. In other words, it'll give you the blueprint on how to bring forward that the credit and or debit that's associated with said award. Check this out. Remember, all I'm offering is the truth, nothing more, nothing less. If you listen long enough, you'll learn something.
This is the current federal tax developments for the week of May the 1st, 2023. Current federal tax developments is brought to you by Kaplan Financial Education and by your state society of CPAs. Ed Zoller is again coming to you from here in Phoenix. We're going to talk about what's gone on this week in the area of federal taxes. This week, we'll start with a discussion of yet another charitable remainder annuity trust case, but in this case, we're not talking about a drafting quirk or problem. that undid a CRAT. We're talking about, in this case, a marketed CRAT, basically tax shelter, that turned out to not really work. And we'll talk a little bit about this because it's not the first time we've talked about this structure. We talked about it back in 2020. We'll also talk about an IRS notice, a couple of IRS items going out, clarifications going out, that discuss the fact that a change of the protocol underlying a cryptocurrency from proof of work to proof of stake does not itself create a taxable event. So we'll talk a little bit about that. There's some concerns there because we've seen various cryptocurrencies move from proof of work to proof of stake as their way to basically get the ledger updated and reward people for doing that kind of work. So bottom line, we at least have the good news that the IRS does not consider that to be a taxable event when a currency changes. Also in the cryptocurrency realm, we have an IRS notice updating the 2014 notice that indicates that, yes, the IRS is aware that at least 2 countries have now recognized Bitcoin as legal tender, but that doesn't fundamentally change the IRS position that still doesn't make them foreign currency for U.S. tax purposes. Rather, they're just standard property and subject to the standard capital gain or loss rules, not the special rules that would impact foreign currency. And finally, we'll discuss a case that I mentioned, I think, last week, where a taxpayer was attempting to claim a deduction for a fairly large payoff of a legal claim, and they were trying to do a cashier's check, get it deducted in the year 2012. We'll discover that, unfortunately for the taxpayer, due to the facts of the case, how things rolled out, even though it was pretty clear that was going to settle the case, they still couldn't get a deduction in 2012 because of the situation underlying it. So with that, let's start with the charitable remainder annuity trust case. This is a case of Gerhardt versus Commissioner, and this is a reported tax court case, 160 TC number 9, that came out on April the 20th, 2023. Now, there actually was a similar case that came down last year that was not issued as a reported tax court case. I guess the theory being that since this was the second case that came from the same set of promoters with the same attorney representing the taxpayer, that apparently maybe the tax court decides, okay, we got to signal clearly that our position is this doesn't work, so quit bringing it back to us. We'll just kind of see what they do. But let's talk about the whole idea of a charitable remainder annuity trust. And we discussed it a couple of weeks ago with that CRAT that had a provision that ended up disqualifying the CRAT. And it was a provision that never actually made a difference, but CRATs are very fragile devices. You have to get them right. Generally, you set up a charitable remainder annuity trust. It is one of the few times where you can give a charity a partial interest in an asset and still be able to claim a deduction. In this case, it's a future interest in an asset. You basically make a contribution of assets to a concept of a charitable remainder annuity trust. Now, in theory, it could be cash, but that's not normally what we contribute. Generally, you're contributing things that would create taxable income if the taxpayer, actually had to sell the asset, convert to cash. So we contribute things that have built-in gains. Now, the trust itself is considered an exempt organization. And as such, tax exempt, it doesn't pay tax on the gain when the property is sold. However, CRTs have a little bit of a quirk. We do track what would have been taxable gain, and we accumulate those layers. And those layers of income items, and they're kind of ranked by the tax rate you would pay, of the income the CRAT has not paid tax on, in prior years because of its exempt status. And when we make payments out under the annuity, in this case, charitable remainder annuity trust, they're deemed to carry out that income. And generally going to carry out first the highest rate income that hasn't been carried out yet, and then follow that with other income items. And only if you exhaust the entire income the CRAT had previously recognized would you get a tax-free portion of your annuity distribution, which would be considered a return of your principal. So that's structurally how this works. And if you've ever worked with charitable remainder trusts, whether they're annuity trust or unit trust, you're probably very familiar with that concept as to how it works. And the flip side of that is, and this could be a deduction for either estate tax purposes, or it could be a deduction for income tax purposes, but you compute using IRS-provided tables and rates. You compute the present value of that future interest that will go to the charity, and you claim a current deduction. In this case that we're going to talk about, the issue was, in this case, a income tax deduction. We talked about a case, the last one we talked about was a estate tax deduction. But it's basically the same either way. Whichever way you look at it, it's a question of the deduction, and the amount would also be the same. But as we noted when we talked about this a couple of weeks ago, it was subject to very strict requirements. A couple of weeks ago, they obviously accidentally ran afoul of the requirements because there was a provision in the CRT, you may remember, in the CRAT, that allowed a payout to be the actual income of the CRAT if it was higher than the minimum distribution required. And the catch was it was wildly unlikely the CRAT would ever have that level of income that would have been more than $50,000 that the annuity was. But that blew up the CRAT. Well, this time we're not going to talk about blowing it up by accident using, a structure that wasn't involved. In this case, the taxpayers had been told about a marketed program that claimed to eliminate their entire tax on gain. And these guys had very low basis, high value property that they were about to sell. And so they were sitting on about a $1.5 million gain. Well, they ran into or referred to individuals that were pushing this charitable remainder annuity trust concept. So they transferred real estate to a purported charitable remainder annuity trust. And again, with the CRAT, that real estate would go in. That wouldn't trigger a tax on transferring to the CRAT, even though we've exchanged the real estate for this annuity interest. However, what it would do is, and when the CRAT sells the property, they generate $1.5 million of gain. Again, not taxable in a CRAT because we don't pay tax at that level. Rather, in a CRAT, we're going to get that distribution of income coming down the line. But these guys said, no. We got all this solved. That's not a problem. We're going to be able to work around this issue. So as the court told us in this case, this particular CRAT had an interesting bit in it. It had two different clauses for payouts. One of which said, and again, this goes back to you get the greater of, and if you remember 2 weeks ago, that right away would send bells off because you remember that was our problem then. You can only get the annuity interest. But let's ignore that for a second. You got the greater of 10% of the initial fair market value of the property, and that value was somewhere around $1,650,000 as recall the case. So let's say $165,000, or the payments received from one or more single premium immediate annuities purchased by the trustee. Now the goal here was to buy the second, because they were going to have a theory where buying the second one, was going to essentially solve all these problems. Well, part of their theory would seem to have worked if you didn't do that. They had a couple of theories about why it wasn't taxable. Now, I think talking with people who have regularly worked with CRATs and CRUTs, and I've worked with them, it's like all of us are like, you're totally misunderstanding how these work. But they're marketing it. It sounded good. They wrote a memo that if you understood CRATs, if you actually read the law, and were comfortable with the law, you immediately said, this is clearly not going to work. But, again, it sounded good. It was, it's kind of like, asking Chat GPT to write you a justification for this. It was it could sound good. And by the way, if you never used Chat GPT or one of those AI chat tools, they're very good at generating things that sound plausible, but can be just totally made up, right? Because their whole job is to sound plausible. Well, they had a memo that sounded plausible. We talked about this back in 2020 when the IRS issued a chief counsel advice that specifically went to rip apart a program which I strongly suspect was exactly this one that was being marketed, because it's, they're on the radar, and obviously these cases coming down last year and this year suggest that, yes, the IRS became aware of these programs, started looking for them, and then started running, basically exams, and eventually ends up in tax court on these cases, right? So the CRAT listed Albert and Gladys Gerhardt as the beneficiaries of the annuity amount. But the CRAT instrument also provided that neither the recipients nor their children have any right, title, or incident of ownership in any special purpose or single premium immediate annuity transferred to or purchased by the trustee. So clearly the CRAT would buy and own the annuity. The annuity would list the recipients, they in essence, they provided the payments that came from this annuity would be transferred out to Albert and Gladys, right, over that term, but they were not actually the people that owned the annuity. Now, confusion about this also gets into this mix because there's going to be two different theories they're going to advance for why a very minimal amount of this payout to, basically Albert and Gladys during the year was going to be considered taxable to them. Okay. So using the proceeds from the sales, they purchased a single premium immediate annuity from Symetra Life Insurance Company for $1,537,822 in March of 2016. The contract identified Albert and Gladys' CRAT as the owner of the SPIA, but listed Albert as the annuitant and Gladys as the joint annuitant. And under this contract, Symetra was required to pay an annuity of $311,708 to Albert and Gladys beginning on April 6, 2016, each April 6 thereafter until 5 total payments were made. So as you might realize, doing the math, they're basically going to get the equivalent of exactly what they had paid. They're going to get all that money out. So what they sold the property for, they would get out. Now, the magic of this was that, in theory, somehow this became a non-taxable event, right? So although there was this million-plus, gain layer, and actually I guess the court ruled it was ordinary gain too. Don't worry about that. That's a separate issue. The taxpayer did not treat any of the payment as coming from that, whether capital or ordinary, it would have been taxable, just the rate would have mattered. But they were saying it wasn't taxable at all. That was kind of their background on this. Rather, they said the only income of the CRAT that would be carried out by any payments was the minor amount of, they called it interest, the minor amount of interest paid by the annuity. So they were taking, so we paid $1.5 million for an annuity. We get a 1099-R from the insurance company, and it obviously is going to give us a certain amount of that is going to be recovery of basis, and the rest be taxable. So a 1099-R came out, and it showed like $2,600, I think, and $22, or somewhere in that range. I guess maybe double that one for each. But it showed a minor amount of interest compared to the total payout of over $300,000. So they picked that up as interest income, but picked the entire rest up as a return of capital. Now, the IRS argued the entire return of basis, I say. The IRS said, no, guys, entire distribution is going to be taxable. Yes, that amount you're calling interest, the earnings on the annuity, which is income to the CRAT, not taxable to the CRAT, but goes in the layer. Yes, you're going to pay that every year, but the rest of what you're going to pay is going to be the income from that initial big gain on selling the property. And that's what the fight's over. Is there a taxable amount from the gain on the sale of the property? That was their argument. Now, as the court explained the law for CRATs, they said Congress has established specific ordering rules that govern characterization and reporting of annuity payments distributed by a CRAT to its income beneficiaries under 664B. And under this regime, distributions to the income beneficiaries are deemed to have the following character be distributed in the following order. First, we distribute ordinary income to the extent the CRAT's current and previously undistributed ordinary income. So again, we're keeping buckets here of income, and we have an ordinary income bucket, and it'll first come out of that bucket. And that's either amounts that we incurred this year or that we previously have picked up and haven't distributed, that remains undistributed in that bucket. The second bucket would be capital gain, right? And again, to the extent we hadn't previously picked that up, we'd pick that up. The third bucket is other income to the extent of the CRAT's current and previously undistributed other income. And then finally, a non-taxable distribution of trust corpus. If we've run out of all this gain that the CRAT hadn't paid tax on, we've exhausted those buckets, then and only then do we pick it up as non-taxable. And this is found in IRC section 664B1-4. That's where you're going to find these rules. Well, the taxpayers obviously said, no, don't worry about that. That's not an issue, or at least the promoters were saying that. And as the court notes, they resisted this straightforward analysis, and they're telling the code does a lot more than exempt them from paying tax. According to the taxpayers and Taxpayers Council and the promoters, the code also relieves them from paying tax on distributions that were made possible by the CRAT's realization of built-in gains. And they tell us all taxable gains on the sale of assets contributed to the CRAT disappear, and the full amount of the proceeds is converted to principal to be invested by the CRATs. And that was in their, basically, in their brief they filed, right? That was in there. In their view, it becomes obvious that Congress intended this treatment to promote charitable giving while offering large tax benefits as incentives. Now, either I and everyone else who has been doing this for decades has been totally wrong about how the law works, has been totally wrong in reading that, or maybe, just maybe, the promoters are totally wrong in how they read it. Well, the court's response to this was the Gain Disappearing Act that the Garretts attribute to the CRAT is worthy of a Penn and Teller magic show. But it finds no support in the code, regulations, or case law. Probably not a good sign for you when they compare your analysis to a Penn and Teller magic show. That probably indicates the judge is being more than slightly sarcastic, and that's usually not a good sign for the result in the case as we move forward. And in this case, it clearly wasn't a good sign. So, what was their argument? Well, there really are two justifications they offered up separately for why it's not taxable. The first was that, the basis of assets donated to a CRAT are equal to their fair market value. And they have that's in their brief. They're kind of arguing that the basis of the asset to the CRAT is $1.5 million, right? They're saying the donor's base is a moot point. The trustee of the CRAT has no way to know the cost basis, nor is required to obtain such information. The tax court is very blunt here, saying straight out, Section 1015 of the Code flatly contradicts their position. 1015 is the section of the Code that governs the basis of an asset when a taxpayer acquires property via gift from another taxpayer. And if you remember, we have carryover basis in that case, subject to some adjustments for gift tax, subject to some quirky rules if there's a built-in loss, but basically it's a carryover basis, right? And a real problem we have here is their claim that Section 1015 does not govern transfers to CRAT because it does not mention them is meritless. This is a mistake I see made many times. How many times have client asked you, show me where in the code it says X is taxable? Show me in the code where it says that the basis of an asset transferred to the CRAT, that's what they're arguing here, is equal to the basis in the hands of the donor. And you're not going to find something worded that way exactly. What you are going to find, because this is how tax laws are written, is 1015 that says in general, the general rule is that when you transfer assets via gift, and this is clearly a gift, a transfer to a charity is a gift, right? It is still a gift, right? A gratuitous transfer. At least, so for the portion of it the charity gets, you're going to qualify for that. The CRAT qualifies for this. That's a gift. And now the issue does not become, but 1015 never says specifically that, giving property to a CRAT triggers this. Well, 1015 never says specifically giving this property to your great-granddaughter, Marie, who was born 2 weeks ago. It never mentioned Marie, and it doesn't say that. The law won't. It has a general rule. You need to look for an exception, and the court makes it very clear. Nothing in the text of the provision excludes CRATs from its scope. They don't need, the burden here is not for the government to show that there's something written in the 1015 that says this applies to CRATs. They won't list every single situation. Your goal is you have 1015 says it applies, just broadly. Whenever there's a transfer, it applies, except as otherwise provided. You need to find otherwise provided. And as the court's noting here, the taxpayers never pointed out an otherwise provided, because honestly, it doesn't exist. That's why they didn't do it. So the court rejected this line, but they do have another backup here, right? They also try to hide behind the taxation of annuities in Section 72. Remember that 1099-R, and there's no question, there was a 1099-R issued by the insurance company, right? The insurance company got a check for $1.5 million. They gave the immediate annuity, and they're going to pay it out over 5 years. So the overwhelming majority of the money coming out over that 5 years is going to be the return of basis, with a minor amount of earnings coming out on top of it from the annuity. Well, now they're saying, see, it's an annuity. It's coming out from there. It is, it's the annuity from the essentially the Symetra Life Insurance Company, and there's a tax amount on the 1099. What's the problem? That's an annuity. This is a charitable remainder annuity trust. That's a tax amount. The court said, you guys had this all fouled up, right? Any amounts paid by Symetra directed by the CRATs constitute an amount distributed by the CRAT for purposes of 664B. So we're not worried about what the taxable amount from what the amount taxable to the trust, right, who owned the policy, who was going to be the one who was going to be deemed to pick up the income. That's not relevant. That 1099 is an irrelevant document because they just turned around and obviously we directly paid it. But they're saying for practical purposes it's paying a liability of the CRAT, and that liability of the CRAT was to pay this out, and that would carry out the income under the standard CRAT rules. It's just like, if you bought a car, let's say let's say you buy a car, you borrow, you basically get 100% financed on a loan, and instead of paying the loan, you turn around and you go get an annuity that's going to pay out monthly, and you just have that go to, the bank, right, and it'll pay them every month. Well, that's just paying the auto loan on your behalf. That is not going to magically change this whole thing into something different from their perspective. Or let's say if the car dealer covered it, it wouldn't suddenly make it a non-taxable event for the car dealer, right? It's one of those things. Any amounts paid is considered to be this. Section 72 isn't relevant because the insurance company is not paying an annuity to the Gerhardts. It is rather that annuity is paying for a stream of income governed by a totally different code section from the CRAT. You can't just put annuity here and magically have it get fixed under these rules, and that's what they're trying to claim.
Now, this should be very, very interesting. This case should be very, very interesting to everybody that is in this class. See, CRAT stands for Charitable Remainder Annuity Trust. A CRT is a Charitable Remainder Trust. CRAT, C-R-A-T, Charitable Remainder Trust, C-R-T, two different types of trust. What's interesting is that this court ruling was made, how it was made, and why it was made. Now, my question to you, based on what you just heard from the presenter of this particular case, was the fiduciaries CECL compliant? Please put your answer in the chat. Based upon the information that you just listened to about this charitable remainder annuity trust, were the fiduciaries operating in compliance with current expected credit loss provisions? Place your answer inside the chat. You got to understand there's a methodology to be used. There is, like the old not Willie Nelson, but the old Kenny Rogers song, The Gambler. You got to know when to hold 'em, know when to fold 'em, know when to walk away, know when to run. See, you got to know who you are in the transaction. But see, this $1.5 million disbursement is what everybody's panties are in a bunch. So can you please, anyone, who's paying attention to what I'm describing, what you just listened to, do you believe that the said entity that was in question operated under current expected credit loss provisions in an aspect of compliance. Please put your answer inside the chat. Do you think they operated in the aspect of CECL compliance? Okay, so we don't have anyone who's willing to put their answer inside the chat. So let me just am I coming in loud and clear? Can everybody hear me? Can everybody hear me? Am I coming in loud and clear? Okay. All right. So in the aspect of this disbursement, the charitable remainder annuity trust was penalized because that disbursement created a taxable gain. One way to prevent this would be to simply call those gains accounts receivables, general intangibles, or you can say general intangible receivables, or if you disperse an amount, general intangible payables. And then acknowledge those disbursements. See, this word income, you're going to have to really be careful of it. Very careful of it. A lot of individuals aren't quite sure exactly which way they should be going with how these things should be looked at. Which now brings us to the contractual indemnities. I got a screen up. Hopefully you guys can see it. We're now going to move to it. Remember, if you listen long enough, you definitely will learn something. All right. First slide that you're seeing right here, it says trust administration. These are the essentials of trust organizations. You see a public side and a private side. They deal with four basic proponents for both sides. The public has trustees, they have a settler, they have beneficiaries, and they operate a certain type of tax strategy. These are the essentials. In the private, they also have trustees, settlers, beneficiaries, and the tax structure as well. And it has here at the bottom, receives up to 60% of what you spend back in your pocket. In other words, if you're operating properly, this should be a good ruling point to receive up to 60% of what you've spent back in your pocket. Now, I want you to look at the column that deals with the public trust. These things are color coded for a reason. So you got the trustees in the color of red, we'll call it. The settlers in an aqua color, and both the beneficiaries and the tax structure, they're both are represented by the same color, which is gray. Let me explain this. Trustees are in the hot seat in the public. The trustees are they're the ones that's in the hot seat, but they're able to operate with a level of immunity. Why? Because the trustees are carrying out what the settlers have put in place. So the trustees of this public trust have received value from the settler. So the settler has appointed the trustee to a certain amount of value and or goods, and these goods are being managed by these trustees on behalf of the beneficiaries. And the beneficiaries are going to be responsible for whatever tax strategy the settler and or trustee has implemented. So the tax strategy that they always talk about in the public is dealing with those subjects under this public jurisdiction. This is why the beneficiaries and the tax structure are the same color. As you notice, the trustee is a different color. The settler is a different color, which means they have a different methodology of accounting. Trustee's accounting is not going to be the same as the settler. The settler's accounting is not going to be the same as the trustee. But the beneficiary is going to have the same overall public policy tax strategy. Does everybody see that? Everybody sees, you're following what I'm putting down. Who doesn't understand what I'm saying? If you're unclear on what I'm saying, please acknowledge it in the chat so I can bring you in. And if you got any questions, please press 9-4 on your keypad. Who doesn't understand what I just explained? Very well. If everybody understands that, now we move to what we call the private side, the private trust. Well, the private trust, it has 4 essential parts. It has trustees, settlers, beneficiaries, and tax strategy. They're all the same color, which means the trustee, the settler, beneficiaries, and the tax strategy should be what? All the same. There has to be an overstanding with the private. This is where the work is. See, it doesn't matter whether you're in the public trust space or the private trust space. You got to understand these basic fundamentals. This is why we call these the essentials of the trust organization. And if you practice the essentials, you can receive up to 6% of what you have spent back in your pocket. That's the beauty of it. See, proper trust administration would allow those fiduciaries to recoup up to 60% of what was dispersed, which would reduce the entire tax liability. But when you're not looking at it that way, you end up on the short end of the stick in public controversy. See, the accounting of the trustees, the accounting of the settler, and the accounting of the beneficiaries in the public are all different. Now, again, if you don't understand what I'm explaining, please speak now, forever hold your peace. Please press 9-4 on the keypad so we can explain. I don't want to go into a long, lengthy debate over something that we can kind of clear up in just a basic question if you have one. Because these are essentials. These are very essential. Okay, I have somebody that has a question. Mr. Bay, you have the floor. What you got? What you got from me?
Okay. You're saying that each one of these have a different accounting method that they're using? Well, the private has a particular accounting method that applies to all parts in the trust, and then the public has a different. Each the trustee and the settler have different methods in the public, even though they're under the same trust.
Right.
So what's that difference?
It depends on what we're talking about. To keep you safe, remember, the public trust is for the beneficiaries that are governed under the public trust. Everybody that wants to get a benefit from some agency is because the agency is doing something for them. Case in point. The reason why the IRS is in your business in the public is because you're taking a benefit. It's called Social Security. They are providing Social Security as a benefit. You're thinking that when you get your fiat back, that's a benefit. That means you screwed up on your math. You're not supposed to get a refund. See, if you do what you're supposed to do, you're supposed to be able to do what you do and have enough. What is Social Security called? It's called Social Security income or supplementary income, which means you're supposed to have what? Something else in place. But if you're making the government didn't say they were going to be your daddy. The government said they weren't going to buy you a house and buy you a car. They said they would provide you the means. You follow me? They didn't say they were going to be your daddy. But because they become so dependent upon them, they are misinterpreting the revenue, the income tax as a benefit. You follow me? Social Security was never designed to support the massive group of people that are on it. Who was Social Security designed for?
Poor white males.
Okay, listen to what I'm saying now. Poor white males. That's not the baby mama. That's not the women. That's not the children. That's for poor white males. So let's call it what it is. If you're not a poor white male, you ain't really got no business thinking an income tax refund is a benefit. Follow me? You follow me?
Right.
That's why they got to have a different methodology of accounting. Most families, when the income tax was introduced, more families were in trust then than they are now. It was just those that didn't have, no place to go. That government had to pick up the tab on.
And then everybody started saying they ain't got nowhere to go.
Right. Listen to this. So when you do that, this is why the private sector has been totally isolated from all that ruckus. Because they're not dependent upon government. Government is dependent upon what? The private sector.
The private sector.
That's why they can write a rule that don't affect them. Now, we're going to go back to what you was listening to in the case. This charitable remainder annuity trust, the fiduciaries got themselves in trouble. You know why? Because there was this $1.5 million disbursement. Listen to me carefully. The trustees are supposed to distribute that 1.5 to the beneficiaries of the trust. Right?
Right.
Let me ask you this. Do you think this particular charitable remainder annuity trust was with a private family or somebody who crossed into this what? Public jurisdiction. Think about it now.
They went into the public some type of way.
How do you think they went across? Based on what you heard.
Right. Based off of what we heard. They went across by the nature of the transaction.
Right, the nature of the transaction, because it what? It was they said the trust ain't liable for the taxes, dummy. The individuals who received it are. That's what we're talking about. The trust don't owe no taxes to nobody.
It's the recipient of the funds who owe.
Right. And these recipients were what? Legal entities, legal fictions, in the jurisdiction of the Internal Revenue Service.
Statutory.
There you go. Follow me? So they called things income and all that. Here we go.
Yeah. They're going off of what you're doing. They're basing it off your action.
Oh, here we go. So the entire case was ruled upon by the Supreme Court system because when it came down to this 1.5 disbursement under the annuity, they was receiving $40,000 a month. That is not what was being taxed. It was that 1.5 lump sum. Did you catch that? As long as they would have extended the contract and received that $40,000 a month for the next 10 years, it would have never been a taxable issue. But because they wanted that 1.5 in the disbursement, here we go.
They could have leveraged that and got that another way.
This is why I'm telling you, if they were CECL compliant, they wouldn't have had this problem. But they're not CECL compliant, so they just like people in the public, they trying to take a shortcut. There ain't no free lunch now. That was a perfect example of how a perfectly good plan went terribly wrong.
Because if they were CECL compliant, that $40 a month could have
It
been
would have never
way,
made the
way
light of
more
day.
than that.
It would have never made the light of day because if you're CISA compliant, you're doing your own CTRs. You never get there. You're never in this situation when you are properly implementing tax administration. When you're doing this, get rich quick. I'm gonna hide the thing under the ball. I don't care what level you on. This is why I stress accounting. There's a perfectly unadulterated system if you do the work. But most people don't want to do the work. They don't want to read. They want it to be somebody else's responsibility. Now, when you go back and listen to this case, when you go back and listen to this training, you're going to hear 2 IRS codes that he gave you the answer on how to do what they was trying to do. He tells you this. The narrator tells you the 2 IRS codes that you need to use when you're talking about an annuity. He tells it to you. Repeatedly. Any other questions from a big bro?
No, not at the moment. Not at the moment. I'm listening.
All right.
I'm all in.
Okay. Technically, you want to understand that there are rules to the road. So let's get to them, shall we? We go to trust administration, and it bears that I show you these images because they say a picture's worth 1,000 words. So maybe if you see the image, it'll burn a hole in your brain, so to speak. Hopefully this trust administration diagram makes sense to most people. Let's move to this particular image here. You see, technically, all this information that you're getting in these trainings, all of the manuals that you're acquiring, all this information is what's going to make up your LEI. All of this data. This is going to make up your LEI. And once you have this LEI, you're going to look like this in the system. And when you look like this in the system, you're able to properly disseminate value. But you can't look like this inside the system until you applied all of this information. And see, a lot of times in a lot of different scenarios, and I'm going to go back here for just a second. See if I'm going to go back, show you this information here. See, we just do the entire screen so you don't get lost. Summary review, because I don't know whether the screen kept up with me when I was going back and forth, so we'll do it one more again. All right. This is an LE. This is basically all of this information that you're learning in these courses. All of this data is going to be implemented into a system, and that's what's going to make up the value under your LEI. And once you have started applying this information, you're going to start to look like this inside the system. And when that LEI is implemented on any type of negotiable instrument, it's going to be carried out a certain type of way. But you can't start looking like this inside the security settlement system until you understand how to apply all of what you're learning in real time. And the most effective way of doing that is utilizing an infrastructure that is accounting first. You know, you substantiate, you do noting and minuting, then you implement the valuation methodology. Now everything else is just, following directions. But let's talk about implementation from a security settlement proponent. Let's talk about trust from an international standpoint. This is actually coming from one of our trust manuals that's entitled, let's see, which manual was this? I think this was the one that dealt with, let's see. I think it stands for private international law, the law of trust. There we go. And this is a subsection D, talks about trust. It says here, the private international laws of trust is substantially contained in the Hague Convention in recognition of trust, given force in England by the recognition of the Trust Act of 1987. The convention, however, has more to do with the identification of the governing law than when the recognition of foreign trust. It defines a trust as a legal relationship created intra vivos or on death, voluntary and evidenced in writing. When the settlor places assets under the control of a trustee for the benefit of a beneficiary or for a specific purpose. However, the 1987 Act extended this to include trusts of property arising under the laws of any part of the United Kingdom or to trusts created by judicial decision. And it applies to trusts falling within its definition whatever date of their creation. Its application to implied resulting in constructive trust is therefore clear. The trust arising from a joint purchase of property will fall within the scope of the act, but where the constructive trust is sought against or imposed upon a defendant found answerable in an equitable claim, the matter is probably within the material scope of the law of obligations, and the relevant choice of law rules will be those in Section E of this chapter. A trust is governed by the laws chosen by the settlor. In default of the demonstrable choice, it is governed by the law with which it is most closely connected. In identifying the latter regard is to be had to the place of administration of the trust, the situs of assets of the trust, the place of residence of the trustee, and the objects of the trust in the place where they are to be fulfilled. The governing law regulates the trust, its construction, effect, and administration. It can be altered, but it gives way to mandatory and conflict rules of the lex fori, or to public policy. The case we just referred to fits perfectly into the aspect of public policy versus lex fori, or lex fori and public policy. And speaking of public policy, one of the biggest things that a lot of new trustees stumble with is, do they really understand HJR 192? So if you don't truly understand HJR 192, my mentor put something together for you guys. Bear with me.
Was HJR 192 repealed? An analysis of the facts by Kevin of the Family Hines. Was HJR 192 repealed? I can't even count the number of times I've had gullible sovereigns ask me this question. They have blindly believed this patriot mythology without thinking it through. That's the problem. Sovereigns who are too lazy to do any research or think through a rumor thoroughly before blindly believing anything they hear or read. Stop watching the NFL games on Sunday and start thinking things through. First of all, HJR 192 is the short name for House Joint Resolution 192. So let's understand what a resolution is. A New Year's resolution applies to you, the one who made it, not to your next door neighbor or anyone else. You're the one who resolved to lose weight or quit smoking or exercise more, and your neighbor is not obligated to do what you resolve for yourself. H.J.R. 192 is strictly a resolution that applies only to the members of Congress who resolved it, and to its subjects. It can be modified at any time by Congress if they so choose, just as you can modify your New Year's resolution if you so choose. However, modifying a public law is a little different matter. The law in this instance for the actual statutes at large books is identified at Chapter 4848 Stat 112. I went down to the SMU Law Library, found it, and photocopied it for myself. It contains the very same wording as H.J.R. 192. However, one is a resolution and one is a public law. Kevin's rule number 4. Always do your own homework. Verify everything, discern fact from error, truth from lies. Never act based on someone else's claims. If I refer to H.J.R. 182, am I not telling the listener or reader that I am a subject of Congress and that I am a citizen of the United States? Sorry, but that is the last thing I want to say. I can, however, say that the federal government has placed insufficient amounts of lawful money in general circulation, namely gold and silver coinage, thus forcing me to discharge my debts with commercial paper, namely putting them off to a future point in time and restricting my obligation as a sovereign to pay a debt. I refer to the federal government's obligation to me as Chapter 4848 Stat 112, not H.J.R. 192. The federal government took away my ability to pay a debt with lawful money, but that doesn't make me a subject of Congress or of the federal government, and thus their resolution does not apply to me. However, their obligation to me under their public law does apply to me because there is insufficient lawful money in general circulation to meet the needs of the people, which includes me. When the federal government took much of our lawful money out of general circulation in 1933, namely gold coins, thus leaving an insufficient amount of lawful money in general circulation to meet the needs of the people, namely only silver coins remaining, the Congress was required to give the people a remedy. Public Law, Chapter 4848, Stat 112, is that remedy. It states that the federal government will pay my debts dollar for dollar. Note, it doesn't say that the government will pay for anything I desire to buy, like a car, only that it will pay my legitimate debts. Most, if not all, of the state constitutions require the state to pay its debts in gold and silver coin. By taking away a state's government's ability to comply with its constitutional mandate of paying its debts in gold and silver coin, the federal government involuntarily restricted a state government's ability to function in a de jure capacity. The de jure states went into suspension after the following 4 acts were committed. Number 1, the taking of gold coins out of general circulation in 1933. Number 2, in 1964, the U.S. Mint ceased minting any more silver coins. Number 3, in 1968, silver certificates could no longer be redeemed for silver. And number 4, on August 15, 1971, President Nixon closed the gold window, thus stopping the redemption of foreign-held dollars for gold. At that point in time, the U.S. dollar was backed solely by the full faith and credit of the American people, and the states could no longer function in a de jure capacity while in a state of suspension. The states went into suspension because the federal government involuntarily forced the state to pay its officers, judges, employees, etc. with something other than gold and silver coin, which was required by the state constitution. This something other than gold and silver coin was nothing more than fiat money, or scrip, backed by nothing but the labor of the people. Thus, constitutionally, the states could no longer function in a de jure capacity because it no longer had the ability to pay its debts in the form mandated by its constitution, namely, contract with the people. Since the federal government took away the gold coin money in 1933, thus causing the states to suspend operations by preventing them from honoring their obligation to pay their debts in gold and silver coin, then there had to be a remedy. Chapter 4848 Stat 112 is the remedy, not just for the states, but also for the sovereign men and women who created the states. Until gold and silver coinage is reinstated in sufficient quantities for general circulation, that remedy cannot be repealed. Congress may have repealed some parts of H.J.R. 192, or even all of it, because H.J.R. 192 is merely a resolution for Congress and its subjects. However, the true remedy is provided to the people by Public Law, Chapter 4848, Stat 112. Until the state governments come out of suspension by the federal government's placing sufficient quantities of lawful money into general circulation, your remedy, pursuant to Chapter 4848, Stat 112, cannot be repealed and will continue to be there. The remedy of the subject/citizens found at HJR 192 might not be there because their remedy is nothing but a resolution. But the remedy of the sovereign found at Public Law Chapter 4848 Stat 112 will still be there because a sovereign's remedy is public law. If, as many uninformed sovereigns claim, the promise that the federal government will pay your debts dollar for dollar is no longer valid, then these sovereigns have no basis for claiming their remedy by using the 1099 OID process for the refund of out-of-pocket funds expended to pay their debts. Either, number one, you believe that the federal government repealed your remedy and therefore there is no 1099 OID refund process available to you, or, number two, you believe the government has an obligation to pay your debts dollar for dollar, and therefore the 1099 OID process for a refund is your remedy, and you can use it to recover the funds you expended to take care of your debt obligations. You can't believe your remedy has been repealed and then try to claim your remedy by asking for a refund using the 1099 OID process. Now that you understand the difference between a resolution and a public law and why your remedy was given to you, you may recall how a well-known patriot attorney who specializes in tax matters has worked hard to intentionally mislead sovereign men and women into believing that their remedy has been repealed. Hogwash. He's talking about a subject's remedy by resolution, not a sovereign's remedy by public law. Please do your homework and think outside the box before disseminating patriot mythology to others, possibly causing them to stumble by your lack of research and knowledge. If you wish to continue arguing this ridiculous allegation without doing your homework, namely refusing to spend the time required in studying the monetary system in detail, please do so privately, not on any public forum, and as not to mislead others with such mythology. By Kevin of the family Hines, a sovereign man with a common law copyright of this, my private intellectual property.
Now, what I found interesting is that when I run into lawyers and people who supposedly are well versed in all these things, I hear these type of buffoonery arguments. And that tells me exactly what my mentor just proved. Everybody don't read. They don't do their homework. Some just go along to get along. And some of these folks, even your lawyers, who have raked out millions of dollars in public debt, would do anything to get that debt taken care of, even if they got to lie to you. Because lying isn't illegal. Perjury is. But if you don't do your own homework, legal maxim says he who has been deceived, let him. Because another legal maxim says the law protects the one who's been deceived, not the one doing the deceiving. Even in their own rhetoric, I've read to you what the trust attorneys who go to Harvard and Yale all know. They said the law is going to spank the one that need to be spanked. It ain't our job to do nothing but let the law do what it does. But isn't in legal maxim the contract makes the law? And what's the definition? Another definition of a contract? Isn't that a trust? So it seems to me that if you're talking to anyone about a remedy, because HJR 192 was a resolution for their subjects. They've created a back door, which is current expected credit loss provisions. If you do the math and conduct your own CTRs, if you act as parliamentary draftsman, you can influence your own legislation. I find it interesting. Does anyone have any questions or comments or concerns over anything you have seen, heard, or learned up until this point? Does anyone need any further clarification on anything that you have listened to up until this point? If you got any questions, please press 9-4 on your keypad. We don't got any questions? No questions. All right. I mean, let me check the chat to make sure I ain't got no questions. Mr. Bay, do you have another question? Does Mr. Bay have another question? I don't know. I'm trying to see if he does. Give me a second.
And that was from early my ham still, Ray.
Okay, no worries. Okay. I think my brother Antoine got a question. Okay. Big bro, talk to me.
What's going on, bro?
What's up? What's up?
Well, I'm just doing just a double check. The resolution was for their subjects, and the public law was, of course, for the
everybody.
people.
Right. That's why it's your inability to pay that gives you the ability to pay. That's why you can. That's why you can minimally get back 6% of what you spent just by doing what you're supposed to do. Minimally 60%. You can get all of it back when you're in trust. But exercising public policy, you can get back minimally 60%.
Right. Right. Just normally.
Right. Like just doing the books. If you just do accounting, 6% of whatever you spent last year and the year before that and the year before that and the year before that, on and on and on, you can use.
I got you. Yeah.
All right, all right. Beautiful,
man,
beautiful.
Right in our face, man.
But that's how they
that
do
non-reading is something serious.
Boy, look at that man. Charlie. Look, that when we don't read, boy, we in trouble. Hold what you got. Let's see who else we got. All right, Miss Monique, can you hear me?
Yes, sir. I can hear you.
All right, all right. Got a question for me?
I do.
Okay.
So the when we're talking about a charitable remainder annuity trust, the annuity is on the trust itself?
See, that's the thing. The annuity is, all right, like the life insurance. The policy is acquired, and then is placed under the control of the trust. The annuity is acquired and then is placed in the control of the trust.
Got it. And then we can direct it to whatever trust it needs to go to as a track.
Right. That's why it's imperative that you master that 15 trust structure and you treat your structure as a complex trust. And then you will avoid these type of pitfalls. And again, the trustees who are out there wilding, you see what they do, right? This is a perfect example. They were able to enjoy for the longevity of that annuity $40K a month. But because they took that 1.5 draw, see, there was a way to do it by what? Creating another trust.
Right. So that was their fatal flaw. They didn't create.
Right. They wasn't CISA compliant. They wasn't CISA compliant.
Yeah, that's what made them not CISA compliant. Okay, that makes sense.
See, like, remember, they created CISA because CISA dealt with loans, leases, and losses. They changed it to current expected credit losses. So when it came to that particular charitable remainder annuity trust, it was tied to real estate. Ding, ding, ding. Now we're getting into leases and losses and land and all that kind of stuff. Now they have very specific rules on how this disbursement go. A REIT is a very special vehicle. So what they should have did, since we're having this conversation, in my opinion, is the annuity, the charitable remainder annuity trust should be dispersing to a real estate investment trust. Then there wouldn't be no problem.
Aha. And that's what you were talking about. And we were having this conversation about why it's important to create those LLCs. Because that's how they avoided the CRT situation.
Exactly.
Mm-hmm. Makes sense.
That's the plan. I'm enjoying it. Everybody's getting this, man. Any other questions? Anybody? Any other questions?
No, it's just a lot. That means that all these trusts have to be created. We have the template, but I'm like, oh my.
Right. You just have to just think about it, but it's a matter of just implementation. That's all. It's the directing of the disbursement, and so the option would be use a K-1, use the accounting rules in your favor. Then they'll do all the heavy lifting for you. You just got to tell everybody what to do.
Right. It took me a long time to figure that out, but it is very clear to me now.
It's right here. It's right here. It's right here. That'll work. So let's try this. I'm finna now see if I can bring my share back up and go into the contractual indemnities, because I think you guys are going to enjoy this part a lot. So let's go into, all right, I'm going to share my screen. Everybody should see my screen now. And so now we go here. All right, we're going to move past the LEI and the M3 asset, and let's now just talk about, let's go into, all right, we just covered the trust, the international laws governing trust. Now let's go into the eligibility requirements to actually withdraw things out of the DTC. And this particular PDF that you're looking at is available when you go to our website. Just simply toggle on the image that says Trust Administration. A download will start. You'll receive this 60-plus page PDF from the DTC and DTCC that's going to explain the eligibility requirements. States here that the Depository Trust Company, a subsidiary of the Department Trust and Clearing Corporation, DTCC, through its underwriting department, meaning underwriting, serves the financial industry by making securities eligible for depository services. The DTC participants, otherwise known as participants, have the ability to distribute new and secondary offerings quickly and economically by electronic book entry delivery system through and settlement through the DTC securities. Through the DTC. Securities may be made eligible for DTC's full range of depository services, otherwise known as full service, or for the limited custody service offered by the DTC. This document addresses full book entry service eligibility. All issuers of securities deposited at the DTCs, are otherwise known as issuing agents, and underwriters are required to adhere to the requirements stated in these operational arrangements, otherwise known as OAs. A transfer/paying agent must be appointed by the issuer prior to a security issued by the issuer becoming eligible for DTC services. This agent must have on file with the DTC a completed operational arrangement agent letter, otherwise known as an agent letter, pursuant to which agreement or agent agreed to be binded by the terms and conditions of the OA in respect to the agent's obligation to the DTC for the security to become and remain eligible at DTC. In circumstances where the requirements cannot be met, DTC, hold on. In circumstances where the requirements cannot be met, DTC can choose to deny eligibility. Let's talk about the standards. Submissions of an eligibility request on DTC. Only participants can request that the DTC make a security eligible. It is therefore incumbent on an issuer to have a relationship with an underwriter or other financial institution that is a participant or is directly associated with the participant that is willing to sponsor the eligibility process for the issuer's securities. A participant may submit an eligibility request through the underwriting services of the DTC at the time a security is initially being offered and distributed in the marketplace, or at a later time and for already issued or outstanding securities. Under new securities that result from reorganizations of already held and eligible securities are also reviewed for containing eligibility. That's a real loaded statement, so I'm going to kind of explain it. Dealing with mortgage-backed securities, they have what they call remix, and they allow certain trustees to get first dibs on all unallocated securities that are in book entry form, which means in layman's terms, if a fiduciary happens to create a REIT, you can simply leverage the balances that are still on these balance sheets for additional real estate purchases. I incorporate a strategy that was used because Apex Capital is a direct Ginnie Mae mortgage-backed security issuer. Because when I became one of the mediators in arbitration under private attorney general's executors, which was Page, one of my fiduciaries, Mr. Harry D. Leiter, great friend of mine, who was a Wall Street whiz kid. When he took ill, he was diagnosed with cancer. And so we had all these things already put in place. And with my background in mortgage-backed securities, we were able to become an issuer. So every month they sent us these unallocated mortgage-backed securities for real estate acquisitions. But you have to have a properly constructed REIT and an ability to understand these eligibility requirements. So in this operational arrangement, they're telling you who these individuals are, what their functions are. Now look at the one in number 3 where it says custody services are limited. Custody services are limited. Typically, securities that are custody only are, for example, subject to transfer restrictions and not part of the fungible bulk and are not therefore eligible for nominee registration or for book entry services. So when individuals have what they call sovereign bonds, they'll fall into this category. But when they tie an annuity or an insurance policy, they'll become eligible. This is what is being done with mortgage-backed securities that are not being allocated, because most individuals that are in a mortgage aren't treating their mortgage as a notional pool. They're not treating their mortgage as an investment. But there is no rule once you receive the HUD, because the HUD is governed under Ginnie Mae. Once you have the HUD, you can legally perfect that Article 9 security interest in that said mortgage. And because you're in physical possession of the HUD, which is the accounting statement, you can then take that actual promissory note and it'll become what? A registered security. And once it's a registered security, you are allowed to participate in this dividends reinvestment plan. In other words, when you make your $1,000 monthly mortgage payment, this dividends reinvestment plan that's governed under the DTC and DTCC rules and regulations for custodial services will allow you to receive 2 to 3 times your initial investment. Because we don't read, they have an incentive to keep the party going with these so-called agents And here's how they define an agent. An agent in these operational arrangements means an issuer's auction agent, a custodian, a depositary, a dividends reinvestment plan administrator, an exchange agent, an issuing and or paying agent, a redemption agent, a remarketing agent, a registrar, a tender agent, a transfer agent. Can somebody unmute themselves so they can see my screen and see what is there saying after the word transfer agent?
Trustee.
What does it say after trustee?
Trust company.
And it also says and or any other persons or entity acting in the agency's capacity on behalf of the issuer. In layman's terms, the DTC has two doors. Remember, to become part of the furniture, you got to be sponsored. That's one door. This is why when everybody was running around talking about the black cards, I got real quiet. Because they do exist. It's just, do you understand, like Chris Tucker and Rush Hour, the words coming out of my mouth? There are rules. There are rules. And they have laid this thing out in great detail. This is why any legal entity that has the ability to incorporate all this data into a digital space can get an assigned LEI that will carry this value throughout the security settlement system. Hopefully, this is starting to make it more clear to most. Now, this PDF is going to literally break down a lot of the things that a lot of people want to know on how to implement such things. Like, for example, I'm going to just scroll through the table of contents so you can kind of see for yourself what this is going to discuss. Of course, we're talking about eligibility requirements, documentation, letters of representation, required riders, indemnity letters, and other assurances, revisions of eligible securities. Can anyone see in the table of contents letter C where it says additional considerations? What does number 1 say? For those of you that already was unmuted and you can see the screen, if you can see my screen, and we're talking about section C where it says additional considerations, what does number 1 state?
Retail certificate of deposit.
Retail, right. Retail certificates of deposits. Now, if you read that section, you should be able to go into your ledger and create private certificates of deposit. Why? Because they're going to tell you what it looks like. This is what you will use in the system. Repeat the question.
No, I was about to ask, where is this document?
If you go to our website, the new website, on the first page, you come down to where you see that picture that says Trust Administration, toggle on it, and the download will start.
All right.
So this is a real good roadmap for those that are in this space. Now, let's get into the meat and potatoes. Let's get to the money shot. All right. We're going to go now to contractual indemnities. What are contractual indemnities? Well, contractual indemnities are promises of indemnity which are found in many kinds of commercial contracts, not just contracts of insurance. So we do know that insurance is like the main type of contract that deals with contractual indemnities. This book examines the nature and effect of contractual indemnities outside the insurance context. It is the first work to provide the detailed account on the subject in English law. The book presents a coherent theory of the promise of indemnity while also addressing important practical issues such as the construction of contractual indemnities. The subject is approached by two perspectives. The foundations are laid by examining general principles applicable to indemnities in various forms. This covers the nature of indemnity promises, general principles of construction, and the determination of scope and the enforcement of indemnities. The approach then moves from the general to the specific by examining separately particularly forms of indemnity. Included among these indemnities against liabilities to third parties and indemnities against defaults or non-performance by third party. The book states English law, but it draws up upon a considerable amount of materials from other common law jurisdictions, including Australia, Canada, New Zealand, and Singapore. It will appeal to readers from those countries. Let me explain this to you for those of you that aren't quite, real big legal scholars. How many guys ever heard of Westlaw? Anybody in the class ever heard of Westlaw?
Yes, definitely.
Yeah, I've heard of it.
Okay.
Yeah, I heard of Westlaw.
Right. If you heard of Westlaw, Westlaw deals with a lot of the so-called codes and provisions that are being cited on a lot of these local court cases. Do you know the jurisdiction of the publishing house that calls itself Westlaw Publication? Well, you probably don't know. They're actually based in Canada. So legally, when you start saying you violate the Controlled Substance Act of and this has been cited under Westlaw, where you're now in the territory of what? Canada. And last time I checked, wasn't Canada still part of the Crown? Uh-oh, don't get quiet now.
Yes.
Isn't Canada still part of the Crown? Part of the Crown?
Yes.
Okay. So using those cited cases, you've just taken yourself out of the constitutional protection that you so claim to love and have. Let me show you how they nail you to the cross. When you got to give testimony to answer against these supposed commercial crimes, what do they tell you have to do? What's the ritual? What's the ceremony they have you perform when you got to give testimony?
You have to swear under penalty of perjury.
Ooh. And when you swear, what do you got to swear on?
A Bible with your hands on it. Like you praising God, but we already know ain't no God in it.
Right. So you literally, they hand you the supposed first law book of Christians, which is the Bible. They have you desecrated by swearing on it. Now remember, once you do that, all bets are off. Now, they ain't doing nothing wrong after that point. Now, if they ask you, do you swear to tell the truth, the whole truth, and nothing but the truth, and you respond with I affirm, it's going to get real interesting in that room. There's going to be a lot of talking with hands covering the microphone. Bailiff, you need to go ahead and holler at him. He ain't doing it right. See, these common law jurisdictions are important. Now, when we get into private law, here's what you're gonna see when we really get into this. I'm gonna go down to Contractual Indemnities, and here. The subject of the book. This is a book about contractual promises of indemnity. The expression contract of indemnity is sometimes used to describe a contract. What's the definition? What's another definition of a contract? What's the word synonymous with contract? What's another word? Not
Trust.
law. Trust. All right. So really get this now. Replace the word contract with trust. Okay? So when they say this is a book about contractual promises of indemnity, the expression contract of indemnity is trust of indemnity. It's sometimes used to describe a trust in which, well, they use the word contract. You see how I'm going? You see how I'm doing this? When I read this, I want you in your head to associate contract and trust. And if you do that, you're going to learn something. For the purposes of this book, it is for the most part unnecessary to distinguish between what? Contract/trust of indemnity and a promise of the indemnity. That is merely one of many terms in a contract trust dealing with a larger subject matter. The principal subject of analysis is a promise of indemnity in a contract/trust rather than a trust of indemnity or contract of indemnity. What is a contractual indemnity? A promise of indemnity is a promise to protect against loss from an event or set of circumstances. It is often expressed in terms of a promise to save and keep harmless from loss or to secure against loss. The term indemnity is, however, elastic. It may be used more generally to describe an arrangement upon which parties is not to suffer losses. When you are operating a properly constructed trust and you have these contractual indemnities, as long as everybody follows the rules, there is no harm, there is no foul. If everybody shows up and the guy really is good as he said he is, great. If everybody shows up and the guy isn't as good as he said he was, great. Why? Because whatever they lost, they're able to what? Recoup, as long as we appear and operate as gentlemen and gentlewomen or fiduciaries or trustees or act civil. Why? Because there were provisions in place. There were other things to secure us against these type of what? Losses. Notice how I'm finna say this. The civilized individuals had provisions and contractual indemnities to recoup their losses. The slaves, the heathens, they raved. They argued. This is why they created this whole separate jurisdiction for the heathens. How do they prove you're a heathen? You're swearing on the Bible, but you profess to know Jesus and all these other things. You couldn't really love him if you ain't read his book. And if you read his book, why are you swearing? The distinction between civilized and uncivilized goes all the way back to when the Constitution was originally put in place. When it comes to the person of color, a melanated man and or woman was even considered a human being. Legal scholars today admit that the Dred Scott case should have been one of more emphasis. But if they told you about the Dred Scott case, they got to tell you the whole truth and nothing but the truth. It's bad enough me trying to tell you that white doesn't mean what you think it is and black is a legal status. How are you going to take it when a Caucasian stand up there and tell you that? So the problem has always been, and we have gotten more and more disenfranchised and become more and more dependent upon this so-called government. So the government had to get more power to take care of more people. That's their justification. If the people become smart, sovereign, and independent, you don't need such a big government. And what's getting ready to happen in June with all those that are not in trust, they're going to expect somebody to what? Pick up the tab. What have you guys have noticed about real estate as of lately with all this stuff that's getting ready to happen and is happening? Is real estate getting more expensive or is it getting cheaper? For those of you that are looking. We're talking about contractual indemnities. This is a relevant subject matter. Is real estate more expensive or less expensive?
It's more expensive from my looking.
So since real estate appears to be more expensive, if something is more expensive, that means if I had to insure it, is it going to cost me more to insure it or cheaper to insure it? If something
more to insure.
More to insure. Okay, so all right, so follow me. For an individual who is seeking a conventional mean of acquiring real estate and their income hasn't doubled and tripled over the last 3 years, their loan document is going to look a certain type way to underwriters. But if you are a legal entity who has the right to borrow and lend, and you're tied to other subsidies and general intangibles like corporate-owned policies, bank-owned policies, and trust-owned policies that can be leveraged, do you think you pay more by using your policy to acquire the property, or do you spend less using your policy to acquire the real estate?
You're going to pay less because you're going to leverage.
Mm-hmm. So it's a buyer's market for those that are in the right position.
But when you explain it like that, it is.
Right. So the buyer's market are enforcing contractual indemnities, these promises to protect against losses from an event or set of circumstances. They are leveraging contractual indemnities and buying the properties at record lows because there ain't a lot of debtors in the marketplace because they can't even afford to be in the room right now. And as long as they're doing the accounting, they don't have to lease out these apartment complexes. As long as they can make the mortgage obligation, they're going to get, 3 times what they put into it. So they got time to what? Weather the storm.
Exactly. Look at that. That's a mean safety net. You see that? And then that keeps the regular buyers further out of reach.
Right. They're going to come back to you when you're ready. After you done got the chip and you done got all the other stuff. You got the FedNow account. You drinking the Kool-Aid. Yeah, you're ready.
Ready for what?
They say you own nothing and love it. Remember? They already said you're going to own nothing and love it now. He'll be ready. See, in northern Florida, 15 LCSs somebody came here this weekend. I ain't say they wiped us out, but somebody had a plan. Like 14 LCSs all reported they're out of precious metal in that capacity. 7 of them don't read up though. But somebody this weekend, you remember there was a state that just reintroduced the silver standard, right? Yeah, what state was that? Y'all remember that in one of the classes?
Tennessee.
There you go. What you just learned on HJR 192, if the state has reintroduced their precious metals window, what does that mean for the residents of that territory?
They want them to come turn in their seals and turn in their metals.
Well, if
or
you got,
they can come and buy them.
If you got a state that has backed its local reserves with precious metals, let me paint a picture for you.
You're a win-win.
If the state
right,
if the state says, I don't know about this Fed now either. So here's what we finna do. If you reside in this territory, you can use this.
So basically, each state finna become their own country like they was intended to be.
Well, unfortunately, brother, you right. But all states, everybody ain't drinking the Kool-Aid, man. I would be checking your territory if I was you.
So
just
this
let you know. Yeah, just let you know. If they ain't trying to do it, you already know what you need to be doing.
Doing it yourself.
I don't know.
And getting up out of there.
I tell you, when they enforce these 15-minute cities, it's gonna be real different. They done put.
So what you gonna do?
Man, look, I am at an undisclosed location, and I've been saying this for the get. I suggest everybody figure it out quickly.
There's going to be honey pots all over Colorado from my people.
Right. Like literally what I want you guys to focus on is that when you're looking at contracts, you can use these policies to buy in, you can leverage your way into the promised land. Let me say it that way. But once you get in, you got to have a plan to maintain. Let what happened in those that are, and I'm gonna use this word candidly. Everybody didn't abuse PPP. Certain folks got PPP and actually did the right thing with it. But let what was introduced during the pandemic serve as your reference. If the individuals who actually received PPP actually did half of what they claimed, they will be that much more further up the chain economically as this wealth transformation took place. But because there was a lot of things that they knew, if I got an insurance policy, right? I got a car that I loved until all the lights on the dash started coming on, and I can't, I'm having transmission problems out of it, and I got all kind of stuff. Like I fixed one thing, something else messed up on it, to a point where this car that I love is gone from an asset to a what? Liability. Now, I don't know about y'all, but I'm going to talk about my family for a second. Now, I got some family members that are a little questionable, and they'll do a little something strange for a little change type deal. And so I called one of my cousins, and he said, "Yeah, come on down." I come on down. We have a good time. Um, I drove the car down there, but I didn't. I had to catch. I had to get I had to get a rental back. Somebody stole the car, and then when they found the car, it was on fire. They burned it. Well, that liability is now an asset because insurance company cut me a check. If you are sitting on toxic derivatives and securities, but you had an insurance policy that you could cash out to recoup 60% of your money because the people that's supposed to be paying you ain't paying you. I can afford the 40% out my own pocket. So as long as I get my 60 that's out there and the 40 that's there, I'm Gucci. I can wait this thing out. Y'all don't see the move? The top 15 REITs in the United States are buying property like there is no tomorrow. But loans are at an all-time low.
Now, isn't that interesting?
Almost to a point where if you had a property that was residentially zoned through certain legislative influence, you can get that residential classified as commercial. We'll keep reading. The term indemnity is, however, elastic and may be used more generally to describe any arrangement under which a party is not to suffer losses. A distinction must be drawn between two kinds of indemnity arrangements. First, those in which essential concerns of the undertaking is to protect the promisee exactly against loss. Secondly, those in which the essential concern of the undertaking is not of that nature, though the promisee is incidentally or effectively indemnified against a loss. This book focuses on the formal arrangements of these promises of indemnity in the strict sense. Usage of indemnity in the latter sense, nonetheless, quite common. It might be said, for example, that A's payment of damages for a breach of contract would be of the amount equal to B's losses, or B's liability to another indemnifies B, or that A's guarantee to B provides an indemnity to B against default by third party. C, or that A's promise to pay B to pay C. A creditor of B affects an indemnity against B's liability to C. Now we come to form and structure of the contractual indemnities. Contractual promises of indemnity comes in a great variety of forms, the best known of which is probably the insurer's promise of indemnity in a contract of indemnity insurance. This book is not, however, concerned with indemnity insurance. Write this word down for those of you that don't own this manual. Indemnity insurance. Write that word down if you presently don't own this manual. What manual is this? Let's see. We're on page what? Let me see what page. So I don't lose my page. We're on page. What page is this? Hold on. That's page 66. Okay, I'm on page 66. So page 66. This is the contractual indemnities. So if you don't own this manual, it's in the bookstore. Page 66. Page 66. Hold on. Where is it? Page 66. 58. 66. Okay. Indemnity insurance. All right. Da 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 da. All right. Let's go to indemnity insurance. Beyond insurance, an indemnity promise that is an expressive term of the contract is often structured in the following way. A, number one, a description of the indemnifier or the indemnifiers. Two, a verb or set of verbs that describe the essential promise. For example, to indemnify, to save harmless, to keep harmless, to make good. Three, a description of the indemnified party. And four, a statement of the scope of the protection provided by the indemnity. An implied indemnity can be conceptualized in a similar manner. Promises of an indemnity can be analyzed along two major dimensions. One dimension is the essential method by which the indemnifier will protect the indemnified party against a defined loss. The two unusual possibilities are to prevent loss and to compensate for loss. The other dimension concerns the origin and nature of the loss against which protection is given. The archetypical non-insurance indemnity is an indemnity against claims by or liabilities to third parties. In other words, if I have revenue that's owed to me, but my debtor hasn't paid me, I have an indemnity clause that allows my person who I owe money to be compensated because of the lack of payment. So I get to actually effectively enforce an indemnity clause in the insurance policy when my debtors haven't paid me. If I can demonstrate that they haven't paid me, then I can use my insurance clause to pay who I owe. Just wrap your brain around that for a second. What if you had a policy, an indemnity clause, that when you lost your job, your source of income, because the job left you, you didn't leave the job, it up and left you, you could use your insurance to pay your obligations until you found another job? Sounds good, don't it? Sounds great, don't it? Who wouldn't participate in something like that if you was in that situation? Who wouldn't get that product? I'm going to say it slowly. Who would not acquire an indemnity product that if you lost income that was detrimental in you taking care of your public obligations, if you were not allowed to make your public obligation because of the lack of substance and income, it would allow you to file a claim where you could make your obligations, to your third party. In other words, they will make the payment for you because you can't. Who would not participate in that program? Okay, so everybody who didn't answer, who was already unmuted, and everybody agrees that's a good plan. So, when you have these opportunities in contract and you don't exercise it, and then they take matters into their own hand legally, have they done anything wrong? Hello? Can anybody hear me?
No, they ain't did nothing wrong.
Okay. If the individuals involved in this situation that don't know that they have an arbitrary clause or contractual indemnity that they can enforce, or they don't see one, and you as a fiduciary, because you don't see one also, you can elect to use one, isn't that a service that you think a lot of folks need when they're getting ready to enter into this new system?
Absolutely.
Arbitration is the key. I want you guys to review what I just covered up until this point in this class. Case in point, when you go back to your DTC model or go back to your DTC 69-page PDF on the website, they're going to give you these things that deal with this, what they call FAST. This is your FAST manual. Those you don't have the new one that came out in January, just let me know. I'll resend it again. They're going to tell you what you put on your ledger so you can get some of this credit back and pass it along. Like if you want to enforce your indemnity clause, you're going to need to know what accounting symbols and titles to use to do so. These are the agency's identifying codes. They'll let you pass that value from one system to the other. Last but not least, we're going to go into the introduction of law, the essentials of trust. It says, we began, albeit with caveats, by offering the following definitions of a trust concept. A trust/contract is a situation in which property is vested in someone, a trustee, who is under legally recognized obligations, at least some of which are of proprietary kind, to handle it in a certain way and to the exclusion of any personal interest. These obligations may arise either by conscious creation by the previous owner of the property, the settler, or because some other legal sufficient circumstance are present. The various components of this definitions has now been reviewed and explained. Although, again, with the caveats, we took the example that of a grandmother's trust for Adam. More abstractly, a settler transferring property to a trustee with instructions to handle it for the benefit of the beneficiary. We then saw how the various features of this may be essential or inessential to trust. This trust arose because its settler so intended, but the trusts are recognized as arising for one reason as well. It had a settler, a trustee, and a beneficiary who were different people. We have seen that the willingness, there may be a trustee, there need not be a settler, and in the place of a beneficiary, the object of the trust might be on purpose. The trust must, however, always, like in the example, involve some property which the trustee will technically own, but as regards the handling of which he will be under certain obligations of legal rather than just moral sufficiency, at least some of which will be attached to the trust property. The example was typically of express trust and involving duties to disperse the trust property correctly and meanwhile to manage it, but the details of the duties and the reasons why people wish to create them may vary considerably. Trust must, however, remain within the realm of what is legally permitted, and they must, in principle, exclude any interest of the part of the trustee. Taking all this into account, the definition can therefore be seen to cover everything that is meant by the trust concept. Some points now need to be made, however, about the two matters that are deliberately omitted from the definition. These are matters that have been suggested as being essential to the trust concept, but that are not. The trust is an equitable concept. Equitable concept. First, it must be said that our description should be redefined by recording that the trust is an equitable concept as opposed to a legal one. Equitable concepts are those that historically were developed by the courts of chanceries, whose chief and for the longtime sole judge of the chancellor, while legal concepts originated in the common law courts in the king's or the queen's bench or the common pleas or the excheator. Trust originated in the chancery and so count as equitable. Noting this fact would certainly add a true detail to our description of trust. It is, however, questionable whether it adds all information of useful significance. The fact that the English legal system historically has more than one set of courts may have contributed to the emergence of the trust concept. Why did I stop there? Two court systems. When you go to court in the public, that's called a public tribunal. That's a court system. Then you hear words like arbitration. That's private tribunal. Two court systems. See, what started all this is what's still intact today. It's just as you get further and further away from the source, you're not actually sure what you're dealing with. There's two systems. There's a public system and a private system. The multiplicity of courts operating along somewhat independent lines probably allow for more enterprising exploration of the conceptual possibilities than might otherwise have occurred. And trust may be seen as one of the products of this process. But it would certainly not be impossible to reproduce the trust concept in a legal system that only ever had one set of courts. And indeed, in England itself, the different courts had been amalgamated for well over a century. So one looks rather for evidence that equitable concepts function differently from legal ones in contemporary law. It is possible to find such evidence, but its power is open to question. One piece of evidence is this. We have noted that if trust property is illicitly passed by the trustee to another person, the recipient will commonly, though not always, incur duties attached to the property. The exact circumstance in which transferees are bound by duties attached to property under equitable concepts are slightly different from those in which they are bound by duties attached under legal concepts. To state that trusts are equitable can serve as a shorthand means of saying that they feature one rather than the other. The set of rules in this respect, but there is nothing in the labels equity or equitable and legal to mean that there are two sets of rules. The differences between them may be that they are, in fact, the modern tendency is of eliminating the differences and the subject both legal and equitable concepts to a single regime of rules regarding the circumstances in which duties attached to property under them will affect recipients. What is the commonality? What is the word that I try to have you guys associate when we talk about legal and illegal when it comes to accounting? What is the word synonymous with legal? What is the word that's synonymous with illegal when it comes to taxable transactions? If something is deemed to be legal, it's deemed to be what?
Non-taxable.
If it's deemed to be legal, it's deemed to be taxable.
Taxable, I mean, right.
And if it's deemed to be illegal, it's deemed to be
illegal.
non.
Right. Taxable.
You see these two distinctive planes, but when you don't understand the origin, you start teetering into the whole, I think I know what they're saying when you really don't. You see how you falter when you don't understand that equitable and legal are actually two sets of rules with differences between them?
Yeah, it's real easy.
When you're not in trust, when they throw that word illegal on you and you don't understand that, a whole lot of problems going to start when they say illegal. This is the only time I'm going to bring this up because it's going to cross a line and an aha moment should come up. When you don't bring up accounting and don't operate in trust and they say you did something illegal, you're in trouble. If you're in trust and they say you did something illegal, you respond with, here's a trust unit. Handle it. Make it equitable. You have my permission. Trustees are always talking down, not talking up. See, when you're a trustee and when they say you did something illegal, they saying you did something non-taxable. Can you please give us some money? They're really asking, they're making a request. When you're in trust. When you're not in trust, that's when the bracelet's going to come. That's when the fine's going to come. That's when they're going to cart you off to prison. Because you what? Arguing. If we're playing the game of tennis and the ball get all fuzzy and won't roll right, what do I do with the ball? I discard it, right? Go get another one. Out of every tennis match, I don't think the tennis ball ever was recognized as the true MVP of the game. Most important part, no recognition. Like Rodney Dangerfield, no respect. And to show you what they mean, the minute you can't perform, you're out of there. So when you're not being a trustee in the game, you're just a tool that the trustees are using. And even though you're screaming at the top of your lungs, ain't nobody can hear you because they're not on what? That level. Your argument is legitimate, but it has no reference in the game. There's two sets of rules. It's knowing when to be the tennis player and knowing when to be the tennis ball. There's nothing wrong with it until it is. I know I've given you guys a lot to think about. I've shown you a lot. We went through about 4 or 5 different manuals in this short period of time. I'm hoping that you're learning something. At this point now, I'm going to open up the floor for questions because I don't want to get too deep. I want you to absorb this information and be able to build on it. Does anybody got any questions, comments, or concerns? I think I got a hand raised. Let me see here. Let me go back to my questions here. So I got a hand raised. Okay. If you got any question, please press 9-4 on your keypad. Okay, I think somebody pressed. Let me see if they got a question here. Let's see. Can't tell. I don't think we got any questions. Did you guys know exactly the status of HDR 192? Before I put that video out there, did you know that there were people going around thinking that HDR 192 has been repealed, but they still want to do 1099 OIDs to recoup a refund? It's like it either it is or it isn't. It ain't both. That's like 80% of folks that are not in these type of studies. They kind of are doing both and wondering why they're not getting a remedy, because you're going against yourself. You're in your own way. Like you want to get a 1099 and go down to the car dealership and get a vehicle. Notice how I'm finna say this. I ain't saying you can't do that. I ain't saying you should do that. I ain't saying you can. I'm going to say that if you believe that the government owes you a car, they have a form for that. Do you think you can just simply just be the beneficiary of public trust and just go down to the local dealership with your paperwork and just hand them the paperwork and drive off the lot with the vehicle?
No. You ain't got no say.
Surely nobody thinks that, right? Nobody thinks you can just do that, right?
No, absolutely not.
Now,
the beneficiary? No.
If you are already in a car loan and you want to extinguish that debt, there's something you can do from that standpoint. Do you have to be in a trust to do it? It'll probably work better if you are. Here's the better question. How does the McDonald Corporation purchase real estate? How does the McDonald Corporation acquire vehicles? Any idea?
I would use the same mechanism what we were just speaking about.
Any idea?
Yeah, the same way that you.
I posted this in Bitrix a few days ago. Borrowing money from a trust-owned life insurance policy can be done through a process called policy loans. Here are general steps to borrowing money from a trust-owned life insurance policy. Number one, check the policy terms before considering a policy loan. It is important to review the policy terms to see if it allows for loans. Not all policies have this feature, and the policy may need to be modified to include it. Number two, determine the maximum loan amount. The policy holder should determine the maximum loan amount allowed by the policy, which is typically a percentage of the cash value of the policy. Number three, request a loan. The policyholder can request a loan from the insurance company, which will require completing a loan request form and providing the necessary documentation. Number four, review the loan terms. The insurance company will provide the policyholder with loan terms, including the interest rate, repayment penalty, and any fees associated with the loan. Number five, accept or decline the loan. Policyholder can then decide whether to accept or decline the loan. If accepted, the insurance company will disperse the loan amount to the policyholder. Note, it is important to note that taking out a policy loan will reduce the cash value and death benefit of the policy, and interest will accrue on the loan amount. If the loan is not repaid, it may affect the policy's ability to pay out its death benefit or result in a reduced death benefit amount. It is recommended to consult with a financial advisor or insurance professional to determine if taking out a policy loan is the best option based upon individual circumstances and goals. TRIPS or troops, business trusts or TBIs are specialized trusts that issue debt securities called trust preferred securities. These trusts were established to allow banks and other financial institutions to raise capital while taking advantage of certain tax benefits. TBIs are structured as unincorporated Delaware statutory trusts that are designed to hold troops as their sole asset. Troops are hybrid securities that have characteristics of both equity and debt. They typically have long maturity date up to 30 years and pay a fixed or variable rate of interest. TBIs use the proceeds from the insurance of troops to make loans or investments in operating subsidiaries of financial institutions. The income generated from these investments is used to pay interest in troops holders. One key benefit of TBIs is that they can qualify as Tier 1 capital under banking regulations. This means that financial institutions can use the capital raised through TBIs to meet regulatory capital requirements. However, TBIs are complex financial instruments that can be risky and difficult to understand. They may be subject to regulatory changes, interest rate risk, and other market risks that can affect their value. It is recommended to consult with the financial advisor or investment professional before investing in troops or TBIs. The security settlement system. The security settlement system is a system used to settle security transactions, which involve the transfer of securities from the seller to buyer and the transfer of funds from the buyer to the seller. The SSS is responsible for ensuring that these transactions are completed accurately and effectively. The SSS is typically operated by a centralized security depository called a CSD, which is a financial institution that holds securities and settles trades. The CSD acts as an intermediary between buyers and sellers, and it ensures that the securities are transferred from the seller's account to the buyer's account, and that the funds are transferred from the buyer's account to the settler account. The SSS operates using a process called DVP, delivery versus payment, which ensures that the securities are delivered to the buyer only if the funds are received from the buyer. This reduces the risk of default and helps to ensure that security transactions are settled efficiently. The SSS is a critical component of financial system because it helps to facilitate the transfer of ownership of securities and the movement of funds between buyers and sellers. It also helps to reduce the counterparty risk, which is the risk that one party to a transaction will default on its obligations. The court registry investment system. The court registry investment system is a system used to manage funds that are held in court registries. These funds may include cash bonds, restitution payments, and other funds that are held in trust by the court. The CRIS is typically operated by a government agency or a financial institution that is responsible for managing the funds held in court registries. The system is designed to ensure that the funds are invested safely and prudently, and that the investment returns are used to benefit the parties involved in the case. The investment strategies used by the CRIS may vary depending upon the jurisdiction and the type of funds being managed. However, these investments are typically low risk and conservative, and they may include investments in government bonds, money market funds, and other low-risk securities. The use of CRIS helps ensure that funds held in court registries are invested in a responsible and secure manner. This helps to protect the interests of the parties involved in the case and to ensure that the funds are available when they are needed. Now, when you listen to this class, and when you come to this part of the class, if you listen long enough, you will learn something. Now it's just a matter of implementation. Before I jump out of here, is there any questions, comments, or concerns over anything we have covered in today's class? Is there anything one would like for me to discuss that I didn't cover in today's class? Please press 9-4 on your keypad. All right. Well, if I have no other questions and everybody is pretty tight on where they're at, I'm going to ask you stay engaged on caster.fm. Arbitration schedule will be going up for those that are already engaged or looking to be engaged in the arbitration. Those that need other, how can I say, direction in their platforms, feel free to reach out to me between the times of 9 and 5 at area code 904-490-0297. With that, I'm going to say peace and love, family. Peace and love.